Hey everyone, welcome back to Corporate Decoder. Today, KNSL just filed their second quarter 2026 report, and I am seeing some interesting trends in their insurance business. Quick note, this is not financial advice, just my take on public filings for educational purposes. While KNSL saw a dip in overall premiums, written their profitability is still strong, and they are growing their investment income significantly. Kinsale Capital Group Incorporated, or KNSL as you might know them, has just dropped their quarterly report for the period ending the 30th of June 2026. This is the report that tells us how the insurance giant has been doing over the last 3 months and the first half of the year. Let's dive into the numbers and see what they mean for the company. First, let's look at their financial health from a big picture perspective on the balance sheet. We see their total assets are a hefty $6.4 billion as of the 30th of June 2026. That is a solid increase from about $6 billion at the end of 2025. This growth is largely driven by their investments, which have grown from $5 billion to over $5.2 billion. Their investment portfolio is their engine, and it is clearly humming along. Speaking of investments, they hold over $5.2 billion across various assets. This includes over $4.4 billion in fixed maturity securities like bonds and over $773 million in equity securities, which are stocks and things like exchange-traded funds. They also have real estate investments in cash. It is clear, KNSL is putting its money to work, aiming to generate returns beyond just insurance premiums. Now, for an insurance company, the biggest liability is usually the money they owe for future claims. These reserves stand at a massive $3.19 billion as of the 30th of June 2026. That is up from about $2.89 billion at the end of 2025. This increase shows they are writing more business and setting aside more money for those future claims, which is standard for a growing insurance company. On the other side of the ledger, stockholders' equity, which represents what the owners actually own, has grown to over $2 billion. A big chunk of that, nearly $2 billion, is in retained earnings. This means the company has been profitable and has reinvested a significant portion of those earnings back into the business, which is a great sign for long-term growth. Moving over to the income statement, we see the company's performance over time. For the 3 months ending the 30th of June 2026, they brought in revenues of over $548 million. That is a nice jump from about $470 million in the same period last year. A huge part of that revenue comes from net earned premiums, which is the money they actually keep after paying reinsurers. This increased by about 9% to $417 million for the quarter. This shows their core insurance business is growing and earning more premium. And what is really powering their profit is their investment income. It jumped nearly 20% to almost $56 million for the quarter. Plus, their equity investments performed extremely well, adding another $56 million in gains from changes in their fair value. That is a significant boost from just $28 million last year. Their losses and expenses related to those losses also went up, but not as much as their income. For the quarter, losses and loss adjustment expenses were $230 million, up about 6%. This is a key metric for insurers, and it looks like KNSL is managing these costs while growing revenue. All of this led to a net income of $175 million for the quarter. That is a really strong increase of over 31% compared to $134 million last year. This shows KNSL is not just growing, but becoming significantly more profitable. Looking at the first 6 months of the year paints a similar picture. Total revenues hit over $1 billion, up from about $893 million in the same period last year. Net earned premiums grew by a solid 10%, and net investment income jumped by over 23%. Expenses did rise, but the growth in revenue and investment income outpaced it. For the first 6 months, total expenses were about $655 million, up around 7%. And this translated into nearly $288 million in net income for the first half of 2026, a nearly 30% increase from last year. Now, let's talk about premiums. For the 3 months ending the 30th of June 2026, gross written premiums were $527 million, down about 5% from $555 million last year. This might sound concerning, but it is important to look closer. The company actually saw a decrease in premiums from their commercial property division due to tough competition. However, if you exclude that specific division, their overall gross written premiums actually grew by about 3.7%, so the story isn't as simple as a broad decline. This means their net written premiums, the amount they actually keep after reinsurance, only dipped slightly by 1.4%. Plus, their net earned premiums, the money they truly earned over time, went up by almost 9%. This is because they grew their business in prior periods and are now earning it over time. And importantly, They are retaining more of their business thanks to higher retention on their reinsurance deals. The loss ratio, which measures how much they pay out in claims compared to what they earn in premiums, improved to 53.8% from 55.1% for the quarter. This means for every dollar they earned in premiums, they paid out less in claims than they did last year, which is a healthy sign. Their expense ratio ticked up slightly to 21.7% from 20.7%. This rise is mostly because they are retaining more business, which means they are paying less in ceding commissions to reinsurers, but the underlying operational costs are well managed. Putting it all together, their combined ratio, that is the loss ratio plus the expense ratio, was 75.5% for the quarter. This is excellent. A combined ratio below 100% means they're making money on their insurance operations before investments. And their investment performance is really shining. Net investment income grew by almost 20% for the quarter, driven by their growing investment portfolio. They also saw fantastic gains from their equity holdings, with a $56 million increase in fair value compared to $28 million last year. The company also highlights a non-generally accepted accounting principles, or GAAP measure called underwriting income. This essentially strips out investment gains and expenses to show the pure profit from their insurance business. For the quarter, underwriting income was $105 million, up 10.5% from last year. Looking at the first half of 2026, gross written premiums were down slightly by 2.9%. Again, this is largely due to that commercial property division facing tough competition, but their net written premiums grew by 1.8% and net earned premiums are up a strong 10%. Their combined ratio for the first half of the year was 76.4%, an improvement from 78.8% last year. This indicates their core insurance business is becoming even more efficient. Investment income for the first 6 months surged by 23%. Their equity investments also performed strongly, contributing significantly to overall profits. Now, let's talk about cash. As of the 30th of June 2026, KNSL had about $490 million in cash provided by operating activities for the first half of the year. They also used about $263 million in investing activities, mainly buying more securities, and around $180 million in financing activities, which included share repurchases and dividend payments. Speaking of share repurchases, KNSL has a program where they buy back their own stock. They have a substantial amount of capacity remaining under this program, showing management's confidence in the company's value and their commitment to returning capital to shareholders. On the debt side, they have notes outstanding totaling about $224 million. They seem to be managing this debt effectively, with no compliance issues with their loan agreements reported. A really important part for any insurer is how well they manage their loss reserves. For the first 6 months of 2026, the company reported favorable development in their loss reserves from prior accident years. This means that the money they set aside for past claims turned out to be more than what they actually ended up needing to pay out, which is a big positive. They saw about $38 million in favorable development from prior years. Kinsale uses reinsurance to protect itself from big losses. They have a good amount of reinsurance coverage, particularly for property and catastrophe risks, and their reinsurers are all highly rated. This reduces their exposure if a major disaster strikes. Overall, KNSL is demonstrating strong performance. Their core insurance business is performing well, with a solid combined ratio, and their investment portfolio is a significant profit driver. While premiums saw a slight dip in one area due to competition, the underlying growth and profitability metrics are very encouraging. My biggest concern is always the potential for unexpected catastrophic losses in the insurance industry, but their reinsurance strategy and strong reserve management seem to mitigate that risk effectively. What I am actually looking for is continued growth in net earned premiums and sustained investment income to drive future profitability. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives.